the Fed is going to hike rates at its next meeting in September. And so the investors want to make sure that inflation is not hotter than what the Fed had been expecting, because that might turn the odds in favor of a rate hike. The odds of a September rate hike went down to just 30%. And at one point, I think it might have been upwards of 70%. But now it's 30% based on the fact that the markets are now reassured by these numbers that the Fed doesn't have to hike. Prices don't tell you the story when it comes to inflation, because prices rise as a result of inflation.
Recent financial market chatter suggests that the Federal Reserve may pause its interest rate hikes as monthly inflation data temporarily matches expectations. However, relying on backward-looking metrics creates a false sense of security regarding real economic conditions. Peter Schiff, a well-known economist, author, and financial commentator, emphasizes that the national debt is less than $150 billion away from hitting $40 trillion, a threshold the United States will inevitably breach within the next month. Massive fiscal deficits are continually driving monetary expansion, guaranteeing that consumer prices will climb higher. Furthermore, as auto loan and credit card delinquencies surge to post-recession highs, the central bank will predictably respond by flooding the economy with even more credit. Soaring crude oil costs and rising producer prices will soon force future consumer price index readings significantly higher, making another aggressive rate hike long overdue. Investors who ignore these underlying debt expansions risk being completely blindsided. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The national debt now is over $39.85 trillion. So we're now less than $150 billion away from $40 trillion, which we're going to hit that obviously within the next month, because last month we ran up over $400 billion of debt in a single month. And so we only need about $150 billion to get to $40 trillion. That is the big number. That is what investors should be paying attention to. The rest of it is a bunch of noise. The monthly CPI numbers are immaterial. They're obviously going to go up because of what we're doing on the fiscal side that is ultimately driving the monetary side. And in fact, look at Trump now, again, upping the pressure over the last week or so on Lisa Cook, right? Trying to get rid of Lisa Cook because he wants to substitute her with another lackey who's going to be voting for rate cuts. That's what he wants. Trump wants rate cuts. He wants more quantitative easing. But of course, we've got more quantitative easing. In fact, look at the Japanese yen. I've been talking about this. We're back above 159. The effects of the intervention are wearing off. Soon it'll be north of 160 again, which means they're going to have to intervene to stop the yen from falling, because if they don't do that, it's going to put more upward pressure on inflation and long-term interest rates in Japan. The yields on the JGBs will be under pressure as the yen goes down, and so there's going to have to be more intervention. And what does that mean? Well, that means that the Bank of Japan, or Japan, is going to have to bring more U.S. treasuries to the Fed that the Fed is going to buy so that Japan doesn't have to sell them. And you know, one interesting point that I didn't even bring up last time when I talked about this is these repurchase agreements have a maturity of 30 days. So in theory, Japan is supposed to buy these treasuries back from the Fed in 30 days. Now what's the odds they're going to do that? Because where are they going to get the money to buy them back? Obviously, if they had the dollars lying around, they wouldn't have needed to do the swaps in the first place. So they're obviously not going to do it. So what are they going to do? Are they just going to constantly roll these things over every 30 days? Now, what happens? I'm not sure. What happens if Japan just says, you know, we don't want to buy them back? I mean, I don't know if they're required to buy them back or that's just an option. I think they decide they can just leave them with the Fed, and then the Fed is stuck with them. Then it's just pure QE, right? Because now the Fed would have bought those bonds, but instead of going into the market and buying the bonds, it would have just bought them right off in Japan. So it's a direct benefit, a direct subsidy to Japan, because Japan ends up getting out of its bonds at a higher price than it otherwise would have received if it had to sell the bonds into the market. But we still end up creating inflation. But now we have a pathway for the Japanese to unload these bonds without crashing the market, because the Fed is basically going to say, I got you, don't worry. We'll do an off-the-books transaction. We'll buy in bulk so you don't have to hit the bids in the market. So we'll see what happens. But this is what investors should be focusing on. They should be looking at the budget deficits here. They should be looking at the budget deficits in Japan. They should be looking at the yen. And again, prices don't tell you the story when it comes to inflation, because prices rise as a result of inflation. They are not inflation. I mean, that's like waiting for the sidewalks to be wet to try to forecast whether or not it's going to rain. I mean, by the time the sidewalks are wet, well, obviously the rain is falling. You got to, try to look at the weather patterns and try to predict, is it going to rain? Don't wait till everything is wet and then say, yeah, it's raining. And so when you look at inflation, you look at these things that I'm talking about. You look at the budget deficits. You look at the money supply. You look at the balance sheet. You don't look at the rearview mirror. Plus, as I've said many, many times, the CPI doesn't even tell the truth about how bad inflation is because of the way it's calculated, the methodology for computing it. It deliberately understates the numbers. Now, we're going to get the PPI tomorrow, which probably does the same thing, but the PPI has been running hotter than the CPI, which in and of itself is a leading indicator of where the CPI is going. But as I've pointed out, looking at the import-export numbers, which are far less adjusted than the CPI, that's a better indicator of prices. But again, when you're looking for inflation, you don't look at prices. You look at money supply. And even Milton Friedman, inflation is everywhere and anywhere a monetary phenomenon. So if you want to know where inflation is going, where is money supply going? Where is credit going? And it's going to continue to expand. And in fact, even now, I'm looking at all these numbers on delinquencies, auto delinquencies soaring. In fact, more auto loans now are getting rejected because people have so much debt they can't even qualify for the loans. Same thing's going to be happening in the mortgage market, credit cards. All this debt is exploding. Delinquencies are at the highest they've been since the tail end of the Great Recession. They're going to go a lot higher than that. So that means the Fed is what? They're going to flood the economy with even more credit. That's what happens when you can't pay back the money you've already loaned. They just make it easier to go into debt and borrow even more, the opposite of what they should be doing.
The Japanese yen continues to experience significant downward pressure, crossing critical technical thresholds against the US dollar. When central banks attempt to stabilize their falling currency through official market interventions, they require massive dollar reserves. To avoid directly selling their holdings of U.S. Treasuries onto open markets and crashing bond prices, an alternative mechanism is utilized. Central banks execute 30-day repurchase agreements with the Federal Reserve, essentially exchanging Treasury bonds for dollar liquidity. Because these short-term swaps are continually rolled over due to a lack of surplus dollars, the Federal Reserve effectively absorbs these government bonds onto its balance sheet. This off-the-books transaction provides a direct price subsidy to foreign central banks while expanding the systemic money supply. While portrayed as standard liquidity management, this process functions as hidden quantitative easing that expands overall credit within the global monetary system. Now, let's get back to the interview.
The government released the highly anticipated July Consumer Price Index. And this is very significant to the markets because they're trying to handicap whether or not the Fed is going to hike rates at its next meeting in September. And so the investors want to make sure that inflation is not hotter than what the Fed had been expecting, because that might turn the odds in favor of a rate hike. Anyway, the number came out and it was exactly as had been expected. The expectation was for a 0.1% rise in the headline CPI. And that was a move in the other direction from the minus 0.4 that we got in the prior month, which was driven by energy. A big drop in oil prices helped to bring down the CPI in May. And the number was still relatively low at 0.1 in July. Year over year, the increase was 3.4%, which was exactly as expected, just below the 3.5% from the prior month. Also, the core, excluding food and energy, was supposed to come out at 0.2 increase, and it came out at 0.2. Now, obviously, if excluding food and energy, prices rose by 0.2, that means food and energy went down because it subtracted or caused the overall number to be lower. And that's exactly what happened. Not so much food, but energy. In particular, gasoline, which was down, I think it was close to 4%. So there was a big decline in the entire energy complex that helped keep the rate at just 0.1. And the core, the year-over-year core, was 2.5%. Again, exactly what had been expected, and 0.1% lower than it was the prior month. And the initial reaction to this was at least inflation isn't any worse than the Fed thought. And the odds of a September rate hike went down to just 30%. And at one point, I think it might have been upwards of 70%. But now it's 30% based on the fact that the markets are now reassured by these numbers that the Fed doesn't have to hike. Of course, the numbers are irrelevant. They're backward looking. In fact, more important data on inflation came out later today that I think is far more significant than this backward looking CPI number. And I'll get to that a bit later in the podcast. But first of all, the reason that the number was still so benign for July was the way they do the accounting. And I had forgotten about this because I had assumed a few weeks ago that the number would be hotter based on the huge rise in the oil price in July. Oil prices were up, 22% or something like that. I think we ended July 82, 83, something like that. We're right around that level right now in energy. Oil prices are about $83 a barrel. We were just below 70 when the month of May ended. But the way they calculate the CPI, they don't compare the price of gasoline or heating oil or any of these energy components. They don't compare the month end. They don't take the end of June and then the end of July. Because if they did that, the numbers would have been way up. What they do is they take the average price for both months and they compare that. So because we had this huge collapse in the month of June and prices started the month of July so low, even though they ended much higher, the net effect when you compare the average of the 2 months showed that prices were down. But that's irrelevant because what that means is that the July number, is still being heavily influenced by the big drop in oil prices that we had in June, and it's really not reflecting the surge in oil prices that we had in July. So I think the number in and of itself is pretty meaningless. And it also indicates that the August number now is going to be much worse, even if oil prices just stay where they are. They don't keep going up. The average in August is going to be a lot higher than the average in July. But I don't think oil prices are going to stay where they are. I think they're going to keep on rising. And I'll get into that a little later in the podcast. What I want to talk more about is what should have been more significant in the minds of investors as far as news that came out today on inflation in the future, which of course is what really counts. When you're an investor, it's future inflation that is going to be your enemy, especially if you're a bond investor. And in fact, the bond market, before I even get to this, the bond market didn't even rally on this number. And then it actually sold off a bit and yields ended up higher on the day. I mean, it wasn't a collapse in bond prices. The yield on the 30-year looks like it went out at 5.25 and on the 10-year at 4.69, but very little movement down. Even though the odds of rate hikes went down, the long-term bonds did not benefit from the supposed good news that the inflation numbers weren't worse than expected. And again, even if they weren't worse than expected, they were still bad. The year-over-year core is still up 2.5%. That's significantly higher, 25% higher to be exact, than the Fed's 2% target. And of course, that number had the benefit of falling oil prices that you're not going to have that benefit in future months. So, but even taken at face value, it's not a good number. And year over year, the headline number is 3.4. How does that square with a Fed that claims that its goal is 2%? 2% inflation, we're at 3.4, and supposedly that means the Fed doesn't have to hike rates. But what it actually shows is if the Fed doesn't hike rates, that 3.4 number is going up, not down. So a rate hike is not only appropriate, but it's long overdue. And in fact, a rate hike significantly greater than the 25 basis points, which would be the most anybody would be looking for, is appropriate.
Government consumer price statistics often present a distorted view of inflation due to specific accounting methodologies. In official monthly CPI calculations, energy components such as gasoline are measured by comparing 2-month average prices rather than month-end figures. Consequently, when sharp price declines occur in a preceding month, the resulting mathematical average temporarily masks recent spikes in crude oil costs. This calculation lag creates benign headline figures that fail to reflect real-time price changes experienced by consumers at the pump. Simultaneously, underlying core inflation figures, which strip out volatile food and energy costs, remain elevated significantly above official central bank targets. A core inflation rate remaining 25% higher than target benchmarks demonstrates that monetary policy has not fully suppressed price expansion. Furthermore, alternative economic indicators such as import and export price indexes display far less statistical smoothing than standard consumer price reports. Relying solely on lagging CPI summaries ignores fundamental money supply growth, fiscal budget deficits, and expanding balance sheets. When public policy decisions are anchored to backward-looking metrics rather than underlying monetary expansion, official inflation targets remain structurally out of reach, leaving long-term bond markets vulnerable to rising interest yields. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.